Right now, as you watch this video, US debt is growing by $88,000 per second. Not per minute. Per second. By the end of this video, in 30 minutes, the debt will have grown by $158 million. Total figure, $36.2 trillion. That's 136% of everything the American economy produces in a year. For context, after World War II, debt was 119% of GDP. Back then, America reduced it to 30% over 30 years. But here's the problem. Back then, America was the only undestroyed industrial power on the planet. Now it's competing with China, fighting deindustrialization, and its population is aging faster than ever in history. Financial alarmists are screaming, "This is the end! Collapse is inevitable! Buy gold!" Optimists respond, "Doomers have always been wrong. America will handle it, like it has for 200 years. You know what? They're both wrong. Because history doesn't show one outcome, it shows three. Three different paths countries have taken out of debt crises. One is managed and slow. The second is chaotic but survivable. The third is catastrophic. And right now, in 2025, America stands at a crossroads. The next 5 years will determine which path we take. I'm going to show you all three scenarios. With specific probabilities. With historical precedents. With indicators that will let you understand in real time which scenario is unfolding. And most importantly, with a concrete action plan for each one. Because this isn't about fearmongering. This isn't about everything will collapse. This is about seeing what's happening before it becomes obvious to everyone else. My name is Name, and for the last 12 years I've been analyzing sovereign debt crises. I'm not going to lie to you that everything is either perfect or catastrophic. Reality is always somewhere in between, and it's always more complex than it seems. So, $36 trillion in debt. 3 possible outcomes. One of them has already started to unfold. Let's break it down. Before we get to the scenarios, we need to understand the scale of the problem. And most importantly, understand how this situation differs from every previous crisis. Current numbers. U.S. federal debt, $36.2 trillion as of January 2025. That's 136% of GDP. But that's just federal debt. Add corporate debt, $13 trillion, 52% of GDP. Household debt, $19 trillion, 71% of GDP. Mortgages, student loans, auto loans, credit cards. Unfunded liabilities, Social Security and Medicare obligations, $76 trillion in present value. Total debt in the American system, approximately $144 trillion. Against $28 trillion in GDP. That's 514% debt to GDP. Now add interest payments. In 2024, the federal government paid $892 billion just in interest on the debt. That's more than the entire defense budget. More than Medicare. And here's the critical point, that's at an average interest rate of about 3.1% across all debt. But new debt is being issued at 4 to 5%. As old bonds mature and get refinanced, the average rate climbs. If the average rate rises to 4.5%, which is still historically low, interest payments will reach $1.6 trillion per year. For context, total federal tax revenue in 2024 was $4.9 trillion. A third of all revenue would go just to interest. Why this is different from 2008? In 2008, the problem was in the private sector. Banks, households, corporations were overleveraged. The government came to the rescue. The Fed dropped rates to zero, the government increased spending, the system was saved. Now the problem is in the government itself. Who rescues the government? In theory, the federal. It can print money and buy treasuries. This is called debt monetization. But there's a problem, inflation. If the Fed prints trillions to buy government bonds, the dollar devalues. Inflation rises. The real value of the debt decreases, but so does the purchasing power of all Americans. This isn't a solution. This is transferring the problem from the government to the population. Why this is different from World War II. After WW2, debt was 119% of GDP. America reduced it to 30% by 1980. How? 4 factors. 1. Economic growth. GDP grew 4 to 5% annually in real terms. The economy grew faster than the debt. 2. Inflation. Moderate inflation of 3 to 4% per year devalued the debt in real terms. 3. Financial repression. Interest rates were below inflation. Bondholders lost in real terms, but this was politically acceptable after the war. 4. Demographics. The population was growing. The workforce was expanding. Every year more workers entered the economy than retired. Now none of these factors work. 1. Growth. Real US GDP growth is 2 to 2.5% max. Not 4 to 5%. 2. Inflation. If it rises above 4%, the Fed is forced to raise rates. And that makes debt more expensive. 3. Financial repression. No longer possible in a globalized world. If treasuries give negative real returns, investors flee to other assets or jurisdictions. 4. Demographics. Boomers are retiring. The ratio of workers to retirees is falling from 3 to 1 to 2 to 1. Fewer taxpayers, more recipients. The math doesn't work. So the simple answer, America has handled it before, doesn't apply. Conditions have changed. But the alarmist answer, everything will collapse, is also wrong. Because history shows, countries have gotten out of situations like this. Just in different ways. Let's look at 3 real historical precedents. And from them, derive 3 scenarios for America 2025 to 2030. Scenario 1. The Japanese path, managed stagnation. Probability, 40%. Historical precedent. Japan, 1990 to 2025. Debt grew from 60% of GDP to 264% of GDP. That's the highest level among developed countries. More than double the US. And so what? Japan didn't collapse. There was no hyperinflation. No default. The economy didn't die. But here's what happened. Zero growth. Real GDP grew an average of 0.5 to 1% per year. 3 lost decades. Deflation and low inflation. Prices didn't rise. Wages didn't rise. Aging population. Median age 49, the highest in the world. Central bank owns 50% of all government bonds. Bank of Japan prints yen and buys JGBs, Japanese government bonds. Effective debt monetization but slow. Yen weakened but didn't collapse, from 80 yen per dollar in 2012 to 150 in 2024. That's a 47% devaluation, but stretched over 12 years. Result for Japanese citizens. Savings slowly lose value. Wages stagnate. Living standards don't rise, but don't crash either. Social stability is maintained because the decline is slow. This is managed stagnation. The system doesn't break, but it doesn't grow either. How this applies to the US. The American version of the Japanese scenario looks like this. 2025 to 2027. Fed keeps rates in the 3 to 4% range despite 3 to 5% inflation. Real rates slightly negative, nominal rate below inflation. Economic growth slows to 1.5 to 2%. Budget deficit remains at $2 to $2.5 trillion per year. 2027 to 2030. Debt grows to $45 trillion, 150% of GDP. Fed begins buying treasuries to ensure market liquidity. Effectively YCC, yield curve control, like Japan. Dollar slowly weakens against a basket of currencies. DXY falls from 105 to 85. That's 19% over 5 years. Inflation holds at 3 to 4%. Not hyperinflation, but above the 2% target. Wages grow 2 to 3%, lagging inflation. Living standards slowly decline, but without acute crisis. For ordinary Americans, this means Savings in dollars lose 3 to 4% purchasing power per year. Over 10 years, $100,000 becomes $70,000 in real terms. Real estate rises in nominal prices but stagnates in real terms. Stocks show nominal growth, but real returns after inflation are near zero. No acute crisis, but slow impoverishment of the middle class. 40% probability. Why is this the base case? Because politically, this is the easiest path. No dramatic decisions. Nobody screaming, default, or hyperinflation. The system just slowly sags. The Fed and Treasury can stretch this out for a decade. Especially if the rest of the world is also in trouble, Europe, China, and the dollar remains the cleanest dirty shirt. Indicators were going down this path. 1. Fed begins YCC, announces it will keep 10-year treasuries below a certain yield, e.g., 4.5%, by buying bonds. Direct monetization. 2. Deficit remains at $2+ trillion, no serious measures to cut spending or raise taxes. 3. DXY slowly declines, not a collapse, but constant downward pressure. If DXY falls below 95, it's a signal. 4. Real yields negative. If 10-year treasuries yield 4% and inflation is 5%, real yield is -1%. Financial repression. 5. GDP growth below 2%. If the economy grows slower than 2% for 3 consecutive quarters, we're in the Japanese scenario. Strategy for the Japanese scenario. If you see these indicators act like this, minimize dollars and bonds, they'll slowly devalue. Hold 40 to 50% in quality stocks, nominally they'll grow with inflation. Focus on dividends, not growth. 15 to 20% in gold/commodities, protection from slow dollar devaluation. 20% in real estate. Real estate grows with inflation, especially if you have a fixed-rate mortgage. 10 to 15% in Bitcoin/crypto, hedge in case the Japanese scenario accelerates to scenario 2. Rest in cash for opportunism, if fire sales appear. Goal, not to get rich, but to preserve purchasing power. Expect real returns of 1 to 2% per year. Better than holding bonds and losing 1 to 2%. Scenario 2, the British path, managed devaluation. Probability 35%. Historical precedent. United Kingdom, 1945 to 1980. After WW2, debt was 250% of GDP. Plus enormous military spending maintaining the empire. How did Britain handle it? Through devaluation of the pound and inflation. Timeline. 1949, pound devalued from $4.03 to $2.80 per pound. A 30% drop overnight. 1950-1970s, constant inflation 5 to 15% per year. Peak inflation in 1975, 24.2%. 1967, second devaluation of the pound to $2.40. 1976, IMF bailout. Britain received a $3.9 billion loan from the IMF in exchange for harsh austerity. Result: debt fell from 250% to 50% of GDP by 1980. But the pound lost 85% of its value against the dollar. Britain's became poorer in international terms, but the debt was liquidated. This is managed devaluation through inflation. How this applies to the US. The American version of the British scenario. 2025 to 2027. Inflation accelerates to 6 to 10% due to Trump tariffs if implemented. Dollar weakness. Wage growth under union pressure. Energy prices, oil volatility. Fed tries to fight it, raising rates to 5 to 6%, but this chokes the economy. Recession 2026 to 2027, GDP falls 1 to 2% for 2 consecutive quarters. Unemployment rises to 6 to 7%. Political pressure. The Fed is killing the economy to fight inflation. 2027 to 2028. Fed capitulates. Cuts rates back to 3% even with 7 to 8% inflation. This is the signal. We're choosing inflation over recession. Dollar begins weakening rapidly. DXY falls from 105 to 75 over 2 years. That's 28% devaluation. Treasury sell off. Foreign holders, Japan, China, Middle East, dump treasuries. Yields jump to 6 to 7% despite Fed purchases. 2028 to 2030. High inflation 8 to 12% per year liquidates the real value of debt. Nominal debt grows to $50 trillion, but as a percentage of GDP falls to 120%, because nominal GDP soars due to inflation. Dollar stabilizes at a new level, but has lost 40 to 50% of value against a basket of currencies over 5 years. For ordinary Americans, purchasing power collapsed, prices on imports, electronics, clothing, cars, rose 50 to 70%. Wages lag, growing 5 to 6%, inflation 10%. Real incomes falling. Savings destroyed, $100,000 in 2025 equals $55,000 purchasing power in 2030. Real estate and stocks soared nominally. House for $500,000 now $800,000, but this only compensates for inflation. Winners, people with debts and real assets. If you have a $400,000 mortgage at 3%, 10% inflation liquidates the debt in a few years. Losers, people with savings in cash and bonds. 35% probability. Why isn't this the base case? Because it's politically toxic. Inflation kills approval ratings. The middle class becomes poor quickly and noticeably. Social stability is threatened. But if the economy enters recession in 2026 and the Fed comes under political pressure, they might choose inflation as the lesser evil. Indicators were going down this path. 1. CPI consistently above 6%, 2 consecutive quarters with inflation above 6%, and the Fed doesn't raise rates aggressively. 2. DXY falls below 90, rapid dollar weakness, a clear signal of lost confidence. 3. 10-year Treasury yields above 6%, the market demands compensation for inflation. 4. Foreign Treasury holdings fall 20% plus, China and Japan dumping treasuries. 5. Fed announces average inflation targeting 3 to 4%. Effective admission that 2% is no longer the goal. Strategy for the British scenario. If you see these indicators, 0 cash and bonds, they'll burn. 50% in hard assets, real estate, commodities, oil, gas, metals, farmland REITs. 30% in stocks, but not tech. Focus on energy, materials, utilities, sectors that benefit from inflation. 15% in gold, classic protection from currency devaluation. 5% in Bitcoin, most risky part, but if the dollar collapses, Bitcoin could soar. Maximize fixed rate debt, take out mortgages, auto loans, any loans at fixed interest. Inflation liquidates the debt. Goal, not to lose everything. Expect real returns of -2% to +3%, depending on timing. Scenario 3, the Argentine path, chaos and restructuring. Probability, 25%. Historical precedent. Argentina. 1998 to 2002. Debt reached 50% of GDP, less than the US now, but critical for an emerging market. What happened? 2001. Government defaulted on $82 billion in debt. Largest sovereign default in history at the time. Corralito, banks froze deposits. People couldn't withdraw their money. Peso devalued, from 1:1 parity with the dollar to 4:1 in a few months. 75% loss. GDP fell 28%, over 4 years, the economy contracted by a quarter. Unemployment 25%, 1 in 4 without work. But then, 2003 to 2010, Argentina recovered. GDP grew 8% per year. Debt was restructured with a 70% haircut, creditors lost 70% of their investment. Economy restarted from a clean slate. This is chaos, but with subsequent recovery. How this applies to the US. The American version of the Argentine scenario, the most dramatic. 2025 to 2026. Trigger: geopolitical shock or sharp loss of confidence in treasuries. Possible triggers: military conflict, Taiwan, major bankruptcy, large bank or state like California or Illinois, political crisis, impeachment, constitutional crisis. Mass treasury sell-off, yields jump from 4.5% to 8 to 10% in weeks. Fed tries to print money to buy bonds but can't keep up. Dollar collapses, DXY falls from 105 to 60 over 6 to 12 months. 43% loss. 2026 to 2027. Credit markets freeze, nobody lends to anybody. Commercial paper market dies. Banking crisis, regional banks fall. FDIC overwhelmed. Stock market crash, S&P 500 falls 50 to 60%. Unemployment jumps to 12 to 15%. Government can't refinance debt. 2027. Government announces temporary debt restructuring, maturity extension, forced conversion to low-yield bonds. Effectively, partial default. Creditors lose 30 to 50% in NPV terms. IMF or international coalition offers bailout in exchange for austerity. 2028 to 2030. Harsh austerity, spending cuts 20 to 30%, tax increases. Economy contracts 10 to 15% from peak. Dollar stabilizes at new low level, DXY 60 to 70. Gradual recovery, but US no longer undisputed hegemon. For ordinary Americans. Catastrophe for middle class, pensions cut, Social Security reduced 30%, Medicare underfunded. Mass unemployment, 12 to 15% officially, 20% plus realistically. Real estate falls 30 to 40%, foreclosures everywhere. Imports become unaffordable, iPhone for $3,000, cars 70% more expensive. Winners: those who held assets outside the US and who were liquid at the moment of crash. Losers: everyone else. 25% probability. Why is this the minority? Because the US is not Argentina. Key differences: dollar equals global reserve currency, 60% of currency reserves in dollars. The world can't abandon the dollar quickly. Market depth: Treasury market is $27 trillion, most liquid in the world. Hard to engineer complete collapse. Military power: US can project force globally. This supports confidence, however cynical that sounds. But, and this is important, if an exogenous shock of sufficient magnitude occurs, major war, large terrorist attack, systemic financial collapse, even the US is vulnerable. 25% isn't zero. This is real tail risk. Indicators we're going down this path. 1. 10-year yields above 7%. If yields spike above 7% and stay there a week plus, it's panic. 2. DXY falls below 80 in 3 months. Rapid dollar weakness, clear signal of flight. 3. VIX above 50, extreme fear in markets. 4. Credit spreads explode. If corporate bonds trade at 500 plus BPS above treasuries, credit is dead. 5. Foreign treasury holdings fall 40% plus, mass exodus. 6. Political crisis, impeachment, contested election, constitutional crisis. Strategy for the Argentine scenario. This is survival strategy, not wealth building. 70% in assets outside US, Swiss francs, Norwegian kroner, gold in Zurich/Singapore, real estate in Canada/Australia. 20% in physical gold and silver, not ETFs, physical. In vaults outside the banking system. 10% cash in multiple currencies, CHF, NOK, SGD. 0 stocks, 0 bonds, they'll crash. Liquidity is key, ability to quickly convert assets and move capital. Goal: preserve 50 to 70% of capital through crisis. If you preserve that, you're among the winners. Concrete strategy. Which scenario is unfolding? So, 3 scenarios. 1. Japanese 40% slow stagnation, managed devaluation, debt grows but system doesn't break. 2. British 35% high inflation, middle class becomes poorer, but debt is liquidated. 3. Argentine 25% chaos, default, restructuring, recovery in 5 to 10 years. How to understand which one is unfolding. Portfolio strategy by scenario. If Japanese scenario, current base case. Portfolio for $100,000. $40,000, quality stocks, dividend aristocrats, defensive sectors, utilities, consumer staples, healthcare. $20,000, gold, physical or GLD ETF. $15,000, real estate, REITs or direct ownership. $10,000, Bitcoin high risk, but hedge in case of acceleration. $10,000, commodities, DBC ETF or direct, oil, agriculture. $5,000, cash for opportunism. Expected return, 3 to 5% real, after inflation. If British scenario, inflation accelerates. Rebalancing. $50,000, hard assets, real estate $25,000, commodities $15,000, gold $10,000. $30,000, inflation beneficiary stocks, energy, materials, agriculture. $15,000, Bitcoin/crypto, maximum risk, but if dollar falls. $5,000, cash minimum. $0, bonds, avoid completely. Maximize fixed rate debt. Take out $300,000 to $400,000 mortgage at 6 to 7% if you can. Inflation liquidates it. Expected return, -2% to +5% real, high volatility. If Argentine scenario, crisis mode. Emergency allocation. $70,000, assets outside US, Swiss francs, gold in Zurich, real estate in Toronto. $20,000, physical gold/silver, in safe, not bank. $10,000, cash in multiple currencies. Exit US markets completely. Goal, survive the storm, preserving 50 to 70% of capital. Dynamic strategy. Not a static portfolio. Rebalance every quarter based on dashboard. Example. Q1 2025, dashboard shows 7/10 indicators in Japanese. Hold base portfolio. Q2 2025, CPI jumps to 6%, DXY falls to 92, yields rise to 5.5%. 5/10 indicators shift toward British. Rebalance, reduce bonds, increase commodities and gold. Q4 2025, yields 7%, DXY 78, VIX 55. 6/10 in Argentine. Panic. Immediately convert 70% to offshore assets. This isn't buy and hold. This is adaptive strategy. Testable predictions. How to know I'm not lying. I don't want to be another alarmist who screams, "Crash!" and then disappears when nothing happens. So here are my specific, testable predictions for 2025 to 2027. If Japanese scenario unfolds, my base case. By December 2025, 10Y Treasury yields will be in 4 to 5% range. CPI inflation 3 to 4%. DXY 95 to 105. Fed will begin hinting at YCC or liquidity support for Treasury market. By December 2026, debt will reach $40 trillion. DXY 90 to 100. GDP growth, 2% for 3 consecutive quarters. If by June 2026 these metrics are not met, my base hypothesis is wrong. If British scenario begins to unfold. Triggers by June 2026. CPI above 6% for 2 consecutive quarters. DXY below 90. 10Y yields above 6%. If these 3 conditions are met, we've shifted to British scenario. I'll publish updated strategy. If Argentine scenario begins to unfold. Red flags, any 2 of 3. 10Y yields above 7%. DXY below 80. VIX above 50, holds for week plus. If 2 of 3 happen, I publish emergency protocol. Transparency. I'll publish quarterly updates. Current values of all 10 indicators. Probabilities of 3 scenarios, adjusted. My personal portfolio, allocation, not specific positions. Track record, what I predicted correctly, what not. This is not financial advice. This is my analysis. But I want you to be able to check me. Main difference from alarmists. Alarmists say, everything will collapse. Definitely. Soon. I say, here are 3 scenarios. Here are their probabilities. Here's how to track which is unfolding. Here's what to do in each case. If I'm wrong, you'll see it in the metrics. And you can adjust strategy. $36 trillion in debt. 3 possible paths. 1. Japanese 40% slow stagnation managed. Real incomes fall 1 to 2% per year. Painful but survivable. 2. British 35% high inflation, devaluation. Middle class becomes poor quickly, but system doesn't break. Debt liquidated in 10 years. 3. Argentine 25% chaos, default, recovery. Catastrophe for most, but fresh start for the system. Main takeaway. This isn't a binary. Everything's fine. Or everything collapses situation. It's a continuum. And your task isn't to predict the future with precision, it's to be ready to adapt. Here's what you should do after this video. 1. Download the dashboard. I'll leave a Google Sheet in the description. 10 indicators, automatic updates, or manual if no API access. 2. Determine current scenario, which indicators where? Most likely we're in early Japanese. 3. Build portfolio for base scenario, 40/20/15/10/10/5, stocks/gold/real estate/BTC/commodities/cash. 4. Set up quarterly review, every 3 months check dashboard. If 3+ indicators shifted, rebalance. 5. Subscribe to quarterly updates. I'll publish analysis every quarter. Tracking metrics, adjusted probabilities strategy. For advanced users. If you want in-depth analysis, spreadsheets, models, historical data, backtests, join the membership. There. Complete models for each scenario. Monthly webinars, Q&A, new data breakdown. Private Discord, discussions, alerts, community. Link in description. Final thought. Alarmists want you to panic and buy gold right now. Optimists want you to ignore the problem and keep everything in index funds. I want you to be informed, prepared, and adaptive. Because the future is uncertain. But your ability to respond to information isn't. $36 trillion in debt. 3 scenarios. 1 has already begun. The question isn't, what will happen? The question is, will you see it early enough? See you next quarter.